Welcome to the Real Property Show, where we talk about building, buying, and selling residential real estate. I'm Brian Freeman, and welcome to the show. Hey everybody, I hope you're doing really good today. Hey, we're going to talk about rent-to-value ratios today, and I want to describe to you what those are and why you might be interested in them, and then where you can actually go to get them in what markets that might be. So a rent-to-value ratio is essentially taking the average fair market rent that you have for a property, a residential rental property that you'd have, and you would take that, let's say it's $2,000, and you would divide that by the value of that property. So what would that property sell for in the open market if you did a comparable sale or comparable sales approach on it? Looked at that, and then you do that division, and then that gives you a number. So for instance, if we had a $2,000 a month rent that we got, and we divided that out by a $400,000 property, that would look at a 0.5% rent to value ratio, and you'd be able to calculate and know what that is. Okay, now if you're an investor, a lot of times prior to all these interest rates coming down, a lot of investors were looking for a 1% rent to value ratio, which is really good. So those are harder to come by today. The huge increase in the equity in these properties in the last year and a half has really dropped that down. And a lot of times now with these interest rates, you can still be in lower. You can look anywhere from like maybe a 0.67% rent to value ratio up, and upwards as a good ROI that you're getting on your investment. So you're not going to see the higher rent to value ratios in a equity market, say like a San Diego, California, or a Boise, Idaho, where you've had a ton of equity increase in these properties. So the property values are really high, but the rents have not kept up, or they were already low prior to Boise, Idaho. The rents were already low. It was not a very good rent to value market in the first place. And now it's even gotten worse with the equity that's gone up even higher. So you will see that there's different markets when you evaluate them. Look as an investor and you're looking at, hey, where can I get the best return on my money? Look at the markets that have a high rent to value ratio, and you'll get a better return on your money. So to give you an example of what a 1% rent to value ratio would look like, you would have $1,000 a month in rent, and you would have a $100,000 property. And these $100,000 properties are getting harder to come by, but there is actually still some out there, but they're more back in the Midwest, and you have to actually go into those markets in order to find those properties. Now, one thing that you can look at too is look at the equity that you have in some of your properties that are in these equity markets, like Boise, Idaho, or San Diego, California. Look at that, and maybe you have $200,000 or $300,000 in equity in a property. You can take that money out of there. You could sell one of those properties that have a low rent to value ratio and actually liquidate that money, take that money, use it as a down payment on a $100,000 property or $200,000 property, and put $20,000, $40,000 down. You could buy 4 or 5 houses with the equity from that one property in that equity market that wasn't giving you a good return on your rent. The monthly return was not that good. You can now put it into a different market and get a lot more cash flow out of that money and see a better ROI. So just a thought on how you can actually take and strategically maneuver to another market by utilizing an asset you already got. In the San Diego markets, or a market where you are able to do a second dwelling or an ADU, what you can do is you don't have to invest into the land. You're able to actually have that, just the dwelling costs. And a lot of times you'll look at that and you go, the rent to value ratio could be really high because I don't have to buy the land, and now all I have to do is invest in the structure. So look at the cost for the improvements and then divide that out by the rent. So instead of the value of the home, you would look at the value of the improvements, and then you'd have the monthly rent that you would get for that, divide that out by the cost of the improvements, and then you get your rent to value for when you actually put an ADU on your property or a second dwelling on your property and rent that out. So that could be a really good rent to value ratio in an equity market that does allow you to have a second dwelling or an ADU. So, all right, so I hope that helps. If you'd like more information, you could visit our website at tfgonline.com, or go to our website at realpropertytv.com. All right, thank you and have a great rest of your day. Hey everyone, thanks for listening to the Real Property Show today. If you'd like more information on how to buy land, how to actually buy a home, how to build a home, how to build an ADU, or how to remodel your home, you can click below here in the show notes where you can get a ton of information on our website. You can also visit our website at tfgonline.com and visit our resources page, and there is a ton of information there that you can get for free. Also, check out our FAQ page on that site. We have a ton of information. So thank you for your time and have a wonderful, wonderful rest of your day.